and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice. In this week's edition of the podcast, I am talking again to Andrew McHattie, the editor of Investment Trust Newsletter, one of our regular look-backs at some of the most recent announcements from the investment trust sector. And the first point to make, perhaps, is that there always seems to be a lot to talk about, Andrew. There's never any shortage of news that is worth talking about. But I guess we should start by just having a quick discussion about the big events of the last few weeks. We've had the UK budget, obviously, and now we've had the US election, which is certainly going to have an implication for what happens to the investment trust sector. And not to mention some interest rate announcements as well from the Federal Reserve and the Bank of England. So looking in the round, Andrew, what's your impression of how markets have reacted to all these various developments?
Thanks, Jonathan. Yes, exactly as you said. Every morning I wake up and look at the news, and there's always plenty to keep us involved with the markets. And it's been a really fascinating time because I think over the recent months, many potential buyers of investment trusts and markets more broadly have been telling me that they're sitting on the sidelines waiting for these big macro events to occur, in particular the UK budget and also the US election. Now, we've had these events and many people are saying these are clearing events, so they pave the way for us to look forward in markets. But I think it's been very interesting to look at the market reaction. And in my view, whilst we're living in very sophisticated times, actually I think the market reaction has been quite simplistic. And it takes me back to the old days of looking at politics quite simply. The markets think that left-wing politics are bad and right-wing politics are good for their finances. And in the UK, we saw this fairly socialist budget where Rachel Reeves was extracting about 25 billion from the private sector and putting that into the public sector. And financial markets have reacted by saying, well, this doesn't look very good for growth. We're quite sceptical about how this is going to be implemented. And equities have come down, bond yields have gone up, and the FTSE 100 index has been flirting with the 8,000 level again. So pretty disappointing reaction in the UK. Whereas in the US, I think in contrast, the reaction to Donald Trump's re-election as president has been very positive from equities. There's a keen expectation of free market policies returning, lots of deregulation, more M&A. And I think actually investors are quite optimistic about that. It may well be different for overseas politics, and I think international relations may suffer, but that's a different question. So I think it's been a very interesting period and quite contrasting reactions.
Indeed, that is true. And of course, in America, we've also seen the fact that the Republicans have now gained control of Congress as well, which means that there will be perhaps less of a break on what this new regime is going to try and do in terms of deregulation, tax cuts, imposing tariffs abroad. These are all parts of the policy agenda. And some people have been saying, of course, well, we don't really know until we see the names of the people who are actually going to do the jobs that are involved in this. And well, there have been some quite surprising names come out, suggesting that Mr. Trump is not going to try and waste time in his second term. He's actually going to try and do a lot of things very quickly, and perhaps some of them quite controversial. I guess the first thing to say, though, about that is that the Federal Reserve is likely to be slightly more cautious about interest rate cuts, I think, in the context of what you've just described. And similarly in the UK as well, I would suggest. Do you think that's a realistic assessment?
I think that's right. I think we had a rosy outlook about the path for future interest rate reductions, and I think we're rowing back a little bit on that. But you're quite right about how policies are going to be implemented, and sometimes that's very different from the rhetoric we see during elections. There was a nice phrase I read about that, actually, that politicians campaign in poetry but govern in prose. And I think very often that's the case, actually, that the more extreme measures that people are fearing or perhaps even hoping for don't come to pass when reality strikes. So we'll have to wait and see how these things pan out. But for the moment, we're certainly moderating those interest rate expectations.
Yes, I think it's also worth bearing in mind the pattern of the US equity market cycle. The best performance tends to be concentrated in years 3 and years 4 of the cycle, and the relative worst is in the first 2 years. And that's because new administrations in particular try to do lots of things, and they aren't always well received by the markets. So we'll see how that all pans out. And meanwhile, over here, we're recording this on Friday morning. Looking back on the performance of the Investment Trust Index, I see that it's actually up a little bit over the last 5 trading days. I think it's up around 1%, which is good. And the discount is still around 14%. I think it may have actually edged out a little bit, the average discount on the investment trust sector. So pretty stable. But let's talk about some of the news that's come out then. Let's start with perhaps Scottish Mortgage, which produced some interim results. And I think the first thing I would say about this is it's striking how much more information they are putting in their reporting now. We know that's been one of their campaigns to try and react to the significant sell-off and discount widening we saw last year. What did you make of these figures, Andrew?
Yes, a bit of information to wade through. And it's good to talk about this trust because it's so widely owned. It is the largest equity trust with almost £13 billion of net assets. And of course, lots of us own it or are interested in owning it. So it's worth having a look into the figures. So the figures themselves didn't look great. The net asset value total return for the 6 months to the end of September was plus 1.9%. And that's quite well behind the FTSE All-World Index, plus 3.6% over the same period. So the headline figure isn't the best. And there was some disappointment with certain parts of the portfolio. So some individual holdings like Moderna and Northvolt, and also the private equity holdings, which account for 23% of assets. Those have been a drag on performance again, which has been the case for some time. Although I think we need to be very careful about just extrapolating from that, because there's a very fair chance that at some point those private holdings are going to be very helpful. So overall, it wasn't a great period, but the managers are reasonably optimistic and they've been finding some interesting new holdings, including the Chinese electric vehicle manufacturer BYD. Interestingly, the Chinese companies are doing quite well, so the managers say. And there is some good news as well. It's not just about that headline figure, because I think one interesting point here is that Scottish Mortgage was, of course, committed to this £1 billion buyback, the largest buyback we've ever seen. And I think there's signals to the rest of the sector where the buybacks are useful and worth continuing with. And in this case, it has spent actually £880 million on buybacks. So it's followed through with its promise, and it has had a significant impact. Prior to the buyback being announced, the discount was in the mid-teens, and now it's on about 9%. So whether or not it's the buybacks that did that, the discount has narrowed. So I think there's some argument there to be had that actually buybacks have been beneficial here. And the other point to make is that actually after this reporting period ended on 30th of September, there's been a significant bounce in the portfolio, a bit of a Trump bounce, I think, in growth stocks. So actually the net assets have gone up by 13% since that time. So I think if you're holding Scottish Mortgage, you're probably reasonably content at the moment.
Yes, and of course another thing I noticed in the breakdown of the performance is that in the last 3 months at least of the year, Nvidia, which has been the kind of poster child for the growth stocks in the US, has actually one of their worst performers over that 3-month period. So there has been a kind of rebalancing a little bit in terms of ratings. Still quite highly rated. If you look at the numbers on the valuations, they're obviously still pretty highly rated in comparison to public markets overall, including the listed stocks they own. So there's still a question. I mean, if the US market remains as it does, very richly valued, there has to be a concern at some point that those public listed equities may be re-rated somewhat. It all ties into this overall story of big tech and so on, of which they have a significant representation. But as you say, overall, pretty impressive comeback from last year, and you have to give the board credit for that, I think. They have done a lot of the right things. Well, let's move on then, and let's talk about another popular trust. This one is in the UK sector, and this is Fidelity's Special Values, managed by Alex Wright of Fidelity, ticker FSV. They had some stonking results, I think it's fair to say.
Well, they did, and I think it's very easy to be dismissive about the UK, isn't it? And to think that we're not doing well. But this perhaps belies that. So, yes, this is a trust I like. I've recommended it. And it's clearly a very strong performer. It's done very well over 3 and 5 years. And actually in the shorter term as well, as we'll say. So it's a contrarian investment approach here that is focused on finding underappreciated stocks. And these are perhaps not what you would anticipate. And I think it's quite surprising when you look through the list of top 10 holdings that you see imperial brands. So if you don't want to invest in tobacco, this is not one for you. They've got UK banks, so NatWest and Standard Chartered, and National Grid. So these are not sexy, interesting growth stocks. These are old stalwarts that nobody loves, and that's the whole point of this contrarian approach. But it's been working pretty well. So in the year to the end of August, the net asset value total return here was 24.1%, which is really an excellent figure and well ahead of the FTSE All-Share over the same period, up 17%. So that, I suppose, poses the question, well, have we seen the best of the growth here? And the manager says not, that the UK value gap remains as wide as ever, and perhaps with some greater political certainty now for the next 4 or 5 years, investors may decide to come back to the UK against an improving economic backdrop. So they're keeping the gearing level up at around 8%, and they have an optimistic outlook.
Yes, and the other thing about this one, of course, is that we've had a lot of news about the outflows from UK equity funds, and that's been consistent now for several years. But Alex Wright makes the point that despite that, it is possible to make significant gains, as he's demonstrated with 24% net asset value total return is a pretty good performance in a year when there have been substantial outflows from UK equity funds. The chairman talks about a quiet resurgence in the UK market, which I think is a good way of describing it. But the interesting thing about here is about the discount. It's still trading at quite a wide discount, this one. It trades in a range between 5 and 10%, I think, normally. But it's still at the outer end of that range. The board hasn't done any repurchases. It doesn't seem to do that, except to protect 10% discount. I think that's the sort of implied number they're talking about. So this potentially could continue to be good value if you think that the UK market is due for some kind of resurgence.
Yes, I view it as a long-term investment, really, and I think essentially you're backing the manager here and his fundamental approach, which has indeed been proven over time. For me, it's not a discount play because that discount's not wide enough. You may get the discount coming in by a couple of points, but I don't think it pays here to really be too focused on the discount. It's not a problem at its current level, and so I think it's perfectly all right, actually, for the board to just be concentrating on the investment management here and not too much on the structure.
And the other point I like about this one is that it's interesting one. We know that the UK equity income sector is a big part of the tradition of investment trusts, whereas the oil companies sector is not such a good hunting ground for investors, has not been historically. But this one has, what Alex Wright does is he actually does cover the whole market, so he can switch and does do from large cap to small cap and so on. So it has a sort of element of distinctiveness about that, which carries out very well. So that's Fidelity Special Values, good results from them. Let's talk next about 3i Infrastructure, which is one of several infrastructure trusts that have been facing challenges in the last 2 or 3 years. I've always regarded this one as the best of the bunch, but what do its latest results suggest, Andrew?
Well, I'd agree with you about it being the best in the bunch. It has been the strongest performer in the infrastructure space. Again, a very popular choice, this one. And it does differ from many of the others in the sector, which are more yielding, and they're really focused on yield. They're yield codes, which means that they have been fairly weak of late, as bond yields have offered a decent alternative, whereas 3i Infrastructure is much more about operating companies, and it's not a bond proxy. And it's done well, actually. Over the 6 months to 30th of September, the net asset value total return was plus 5.1%, which doesn't sound that exciting, but it is an infrastructure trust, and actually that's ahead of its target return. The interim dividend is also up, and the board says the portfolio is performing ahead of expectations. So it all sounds very positive here, and I think structurally as well, the trust is in a good position because it's achieved 2 good exits recently above the carrying value. One was in a company called Valorum, which is a renewable energy stock, and the other one is in Future Biogas, where it sold a stake there. So what that means is that it has cash coming back into its portfolio so it can reduce its debt. So it's in a strong position now to look forward and to continue to benefit from the opportunities in broad infrastructure.
Yes, it's a good example of the fact that headline yield is not necessarily the best guide to medium longer term performance. Looking at the 10-year numbers, this one has produced an annualized percentage total return of about 12% per annum, which is terrifically good, I think, for that kind of business. And you contrast that with some of the other infrastructure trusts, which have paid a higher dividend, to be sure, but still their total returns are significantly lower than that. So that's an interesting one. That's still trading on a discount of around 12%, according to what I can see. So that's an interesting one to look at, perhaps. Let's talk next about Henderson Far East Income. This is an interesting trust, ticker HFEL. It's produced some results. Tell us about the results, first of all, and then we'll see what we think about this one.
Well, it was a very neat segue there talking about high dividend yields, Jonathan, because this one is known for its high dividend yield. It is the highest yielding of all equity investment trusts at about 10.9%. And that is what attracts investors to this trust. But I think it's a really interesting case to talk about this one and maybe have a bit of a discussion about exactly what that means, because in performance terms, this trust does not look strong. And this was true actually in the last set of results for the year to the end of August. The net asset value total return of 11.9% was behind the index, which was up 13. And that continues a record of underperformance, which over 5 years is really very marked. And so on the face of it, actually, this doesn't look like a good trust. Its NAV total return is pretty poor. It's well behind the other Asia Pacific income trusts. And interestingly, I had a meeting actually with a salesperson from the managers, Janus Henderson, and I mentioned this as the potential sick child of the family. And he was stunned actually by the fact that I would think that, because he said, well, this is on a premium rating, this trust. We've been issuing stock. Shareholders are all very happy. And that made me think about it. Well, we're not always after big net asset value total returns, are we? We're not necessarily focused on total return. Actually, if investors are getting an 11% yield, which is covered more or less by the income here, then perhaps that's all they're looking for. So I don't know quite what to think about this one. I'll be very interested to have your thoughts.
Well, I looked at this morning, and it is bizarre, isn't it? I mean, it's one of the very, very few equity investment trusts that are trading at a premium, as you say, at the moment. And it's doing so basically on the back of this yield. I looked at the 10-year total performance, yes, and, well, I don't know how to describe it. I think I have to come up with a word like nugatory. I think that would be a good one. It's basically, you're getting the income today and you're not getting poorer over time, but you're not getting any richer over time. So it is a bizarre one. People value income, we know, and there may be for financial planning reasons you want income at a certain time of the year and so on. So you can make a case for it on that grounds, but it is perhaps, well, I don't know, I'd have to suggest that this is a bit of a market failure going on here. In other words, that there are investors who are perhaps being seduced by the high yield when they perhaps shouldn't be looking more closely at the performance over time, because, as you say, the share price performance has been, well, very poor. I mean, the share price is down 30% over 10 years, which is fine. You've got paid some income today, but you are suffering in the longer term. But if the punters like it, what can you say? I mean, I don't know what to say, really. I'm a bit at a loss of words here.
It's an interesting trade-off, and I think you could have done much better, actually, if you'd bought a competing Asian income trust that was paying you maybe 4 or 5%, and then each year you sold a few of your shares to boost your income that way. But you're right, that headline yield somehow just is devilishly attractive, and people like that. So there we are. Give the people what they want, perhaps.
Maybe. Well, there's nothing wrong with that, I guess. That's what capitalism is about. Give the people what they want. You are listening to a Moneymakers podcast. We are an independent research and publishing venture, and grateful to J.P.Morgan Asset Management for their generous, no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements, and many other regular features, including more than 160 in-depth trust profiles, regular market commentary and videos, plus the editor's favourite funds. Never miss a thing that might affect your portfolio. So sign up today at money-makers.co. And thank you for listening. Let's talk next about another very interesting situation. This is a trust which also has very poor headline performance, and that's Weiss Korea Opportunity Fund, which obviously invests in Korea. The share price performance of that one has been pretty dismal over many years, and it looks like it's coming to the end of its life, but for a slightly different reason to the one we normally hear.
I think this is worth talking about, not because many people will be invested in Weiss Korea. Obviously, it's a very niche trust, this one, but because of the unusual circumstance. So we've seen quite a number of trusts reach winding up votes or the end of their lives in some way, or strategic reviews because of their poor performance or because shareholders want out or because they're on a wide discount. But in this case, actually, the shares are on a 1% premium and there's really no immediate catalyst for any change. But the managers themselves have said that they do not see attractive prospects for their sector going forward. And this is perhaps because they invest very specifically in the preference shares of Korean companies. And that seems to be a market that's drying up and the opportunities really are disappearing. So the managers themselves have triggered this strategic review because they're saying we don't see any great opportunity for returns going forward. And that's really rare. I think it's quite refreshing. It could be that the managers didn't really have any choice because they're not going to be able to continue with the mandate. But nevertheless, I think it's worth highlighting just because we don't normally see managers turning away money.
Indeed, we don't. You're absolutely right. That is interesting. Let's talk about, well, there's a company called HH2E, about which I know absolutely nothing, but you're going to enlighten me what it is and what it does, and why that is relevant to the news that's come out about that particular venture, why that is bad news for a couple of investment trusts that we could talk about.
I think you can probably be forgiven for not knowing this German green hydrogen developer, Jonathan, but it has been in the news because it's entered administration, and that's bad news for a couple of investment trusts. So essentially, this is the problem with early stage assets. They can go wrong because by their very nature, they are somewhat speculative. And in this case, this developer was looking to find new external investors and it didn't find any. And that meant that Foresight, who were the primary investors here, decided to pull the plug. And that was bad news both for Foresight Renewable Energy and also for the Hydrogen One Capital Growth Trust, who were both investors. So Hydrogen One had invested £7 million here, and in fact the carrying value was higher at 11 million, and essentially they're not expecting any recovery of that. So that's pretty bad news actually, and that accounted for about 8% of the asset value. Now what is interesting is that the shares in Hydrogen One reacted very strongly to this, and they're down by 35% over the week in reaction. And that looks immediately like an overreaction, but you could say, well, actually, this circumstance, shocking as it is, just illustrates the risk and brings that home and potentially undermines the judgment of the managers as well. There is one particular weakness that indicates, which is that because Hydrogen One is a relatively small trust, it tends to be a less important investor here. It's not the lead investor. So it wasn't making the decision on this. It just had to accept the fact that Foresight wasn't funding it anymore. So that's a little bit of a weakness. And nevertheless, I think if you're a contrarian investor, you might feel that's an overreaction, because if you value this investment at zero now, then the discount on the NAV for Hydrogen One is about 73%. So that does look quite interesting, but obviously it's risky at this point, and a number of speculative investors have had their fingers burned lately trying to chase these kind of positions. And for the Foresight Trust, it's less problematic because it was a smaller proportion of their total. It was about 2.6%. But again, the shares there are down about 9% over the week. So we've seen a significant reaction. In that case, their dividend is still covered for that trust. And I know that the managers are hitting the road to speak to investors to reassure them. I've got an appointment in my diary, so I'll be following up on that one.
I guess the situation with Hydrogen One is that it is a much, much smaller trust. It only came to the market quite recently, and it's only valued, I think, market cap around 30 million at the moment, albeit because of that substantial discount you mentioned. And the shares are at 24p or something, which compares to an issue price, normal issue around £1. So that's not been a great performer. You have to wonder whether that does have a future now. In the case of the Foresight Trust, yeah, much bigger, 500 million market cap, also trading below the original issue price. And it has traditionally traded at a quite significant premium, I see, looking back at the history. But for the last couple of years, it's now at a discount. So, well, I'm interested to hear what you learn, Andrew, whether you think this actually is a potential bargain in the making, or whether it's just a case of perhaps a more general problem surrounding the renewable sector. I mean, the renewable sector has been disappointing, even though over the last year, I think it's fair to say, combination of things, higher than expected interest rates, power prices have been weak, and so on. They just haven't recovered, have they, at all so far? They're still paying a decent yield, some of these trusts, but in capital terms, they've done very little over the last year. In fact, it's been one of the great dogs that hasn't barked, I would say.
It has been very poor, actually, and certainly very disappointing. But I feel that the shakeout is now occurring, which is maybe why this kind of news is coming out. And managers are starting to actively recycle the capital in their portfolios. And they've been talking about that for a while, saying that they'd like to invest in their pipeline, but they just can't raise more capital, and so they're a bit stuck. But now it seems to me that deals are actually being done and assets are changing hands. And I think that is quite encouraging. So undoubtedly there will be winners and losers, but I think at the present time, if you are a disappointed investor in some of these trusts, you can probably take some heart from the fact that things are moving. And I think we may have reached an inflection point. I can't say for sure, and it may be that the returns won't be great over the next 6 months, but I think there's a good case here to be patient.
Okay, well, we talked about rationalisation in the sector. We've been talking about rationalisation in the sector for a long time now. And of course, it has been occurring on a significant scale. You've written an article about that for the next edition of the Investment Trusts Handbook, which is coming out next month. So you've been tracking this very closely. Perhaps we could just tie up some loose ends of trusts which are entering a period when we're going to be saying goodbye to them for various different reasons, whether that's takeover, wind up, or whatever it might be. So let's just pick out some names here. Let's start with J.P.Morgan Core Real Assets, ticker JARA. This is an attempt to offer investors a diversified exposure to infrastructure around the world, global. And unfortunately, this trust just hasn't really worked, has it, since it came to market a few years ago?
It hasn't, and it was a pity really, because it seemed like a good concept, having this one-stop shop for alternative assets, but no, it didn't really do the job. I think it was rather mistimed, and the US property did poorly, so the trust failed its continuation vote, and that triggered the board then to suggest a managed wind down, so that's what's going to occur here. And this really raises an interesting question of what to do when you're faced with a holding that is going into a managed wind down. Do you wait and be patient and wait for that money to trickle back to you, or do you just sell out and reinvest because you're not going to get much of a future return? So obviously you should examine each of your holdings on their own merits. And in this case, actually, I think the prospects look quite good for a quick return of capital. Often it's about the pace you can get it back at as well as the price. And in this case, about 15% of the assets are fairly liquid. Some of those are in listed holdings. And the rest are in J.P.Morgan funds, private funds, where the trust can request an exit. And what it's said now is that it expects to get 50 to 60% of assets back in cash by the middle of next year, and then the remainder over the following 12 months, which is a fairly quick return of capital. And I'm thinking that because these are in J.P.Morgan funds, rather than being single assets, they've got a reasonable amount of certainty about the price. So they should be able to obtain a value fairly close to the net asset value, which at the end of September was 88.9 pence per share. Now the shares have come up to about 75. They've had quite a good rise in reaction to this news. And I've seen some interesting broker analysis actually, which really went into considerable detail about the returns that might be achieved. And I think there's a good prospect here for getting your money back by the middle of 2026 with a bit of an uplift. The shares are probably up with events now after their rise, but overall, shareholders are going to get a better outcome than they might have anticipated a few weeks ago, although still not a good one.
I guess the other factor to consider in all these situations is how and where you hold the shares in these things. So if you hold these things in an ISA, then what I'm going to say is not relevant. But if you hold it outside an ISA or a tax-efficient structure, if you like, we know capital gains tax is going up, and you might want to think about what you can do with the holdings you have, which may be going out at a loss. There could be some tax planning you can do, if certainly next year, if you think capital gains tax is going to be higher, and you've got other things which are potentially liable to CGT, then you might think about those kind of factors in all these situations. It's not always totally write off of the money you've lost since these things came to market. Let's talk about some others then. Let's mention a couple of the debt funds, GCP Asset-Backed Income and Blackstone Loan Financing. What's going on there, those two?
I'll run through these fairly quickly, but I think the two are in a very similar situation. And I think these are quite interesting as examples of where a wind down appears to be working in favour of shareholders. So they're both winding down. They both paid back the first tranche of money in June. and now they're paying back a second tranche. Actually, that feeds into what you were just saying, Jonathan, about the reality of having holdings that may be outside of an efficient tax wrapper. If you're getting money trickling back in 5 or 6 tranches over time, you're going to have a lot more paperwork and a lot more calculations to do than if you're selling them in one go. But anyway, what's happening here is that with the GCP fund, the GCP asset-backed income, they returned £143 million in June, which was about 37.5% of the shares, actually. And they're giving another £45 million back to shareholders now at NAV, which is another 19% or so of the share capital. And they're doing that with a compulsory redemption of shares, which is a fairly standard process. And it's working well, actually, because you get an uplift each time this happens. You get more of your cash back, you can reinvest it. And I think actually it really has paid to be patient here. It's quite interesting to look at the share price. With GCP asset-backed income, the shares started the year at 66 pence. They're up to 79 pence now. And you've had quite a lot of your money back at the NAV, which is close to 90 pence a share. So you've actually done quite well from this winding down process so far. About half the money will have come back now. There's more to come back next year. And then this one should be finished by 2027. The other one is actually very similar, which is Blackstone Loan Financing. Again, made its first return in June, is making a second return now. These are a bit smaller in quantum because overall it's only about 20% of the share capital that's returned. And in this case, you've got to be a bit more patient because their portfolio of CLOs is going to take a bit of time to mature. So it could be up to 7 years in total, which sounds ridiculous. It sounds far too long. But again, actually, so far, being a patient investor has been very worthwhile because you're getting a good return of capital at NAV. And the shares are still on a discount. So in this case here, in a very similar position to GCP, that the shares started the year at 60 European cents, and now they're 75. So it's been worth holding on. And in both of these cases, you're getting your money back. You can recycle it. So if you can deal with the paperwork, and maybe if they're inside your ISA or your SIP, then I would just hold on.
Yeah, interesting point. Well, it does underline, of course, the fact that when trusts get into difficulties, if you sell out immediately or you just decide you can't take any more, it does create opportunities for the smart professionals to make some nice returns by coming in at these sort of levels. And if they understand the process fully, it can be quite productive. But as you say, if you stick it out, then what you have to do, I guess, is just to compare it against the opportunities you can see elsewhere and whether they'll produce better returns or not. Let's mention Tritax Eurobox. This is one that we are going to say goodbye to fairly soon, I think.
Yes, there was a takeover battle here for this one because there was an initial all-share offer from the UK REIT Segro, which was then trumped by a cash bid from the US fund managers Brookfield Asset Management. And there was some question actually as to whether Segro would then come back with a counter-offer. As it happens, they said no. So Brookfield are winning the day with a cash offer of 69 pence a share. What's interesting here, though, is that effectively those two counter-bidders, rather than bidding against each other, they decided to get together and divide the spoils. So actually Brookfield has agreed to sell about a third of the portfolio to Segro for 470 million euros. So they're quite happy with that, and it's a decent outcome, actually, for Tritax Big Box Euro, but there's no further action to be had here.
So that is another, I was going to say nail in the coffin. I don't mean nail in the coffin of the commercial property sector. But we have seen a lot of trusts disappear, I think. Certainly getting over half the trusts that we had in the commercial property sector not so long ago have now disappeared or are disappearing. Do you have any thoughts on the survivors, if you like? Are we going to see any more consolidation, or do you think we're pretty much done now as far as commercial property is concerned?
I think I'd be unwise to rule out a little bit more. There are still, I think, some that could be vulnerable, those that haven't performed well or might have particularly desirable assets and they're still trading on a discount. And certainly the valuation still suggests that that's a possibility. There's still some value to be had. So no, it might not be finished yet, but of course there will be survivors and those will tend to be the stronger ones. So as we often say, it's a Darwinian process and you hope that you come out stronger at the end.
Yes, there are a couple I can think of which are a bit caught in the middle, if you like. They're not big enough really to be considered viable by wealth managers and so on. They need to have a particular specialist niche, I think, to provide them with a certain future at least. But we'll see. They may be able to grow their way out of this. So I think finally in this list we're going to mention briefly Baillie Gifford China Growth Trust. We know Chinese trusts have been going through a very interesting period. They've had a period of poor performance. They had a spike when the Chinese government announced a series of stimulus measures. What's going on with the Baillie Gifford China Trust?
Well, there's been an interesting piece of news here, and I think this is turning into a bit of a bugbear for me. I may be turning into a grumpy old man, Jonathan, which I've been trying to resist, but sometimes things just annoy you. And in this case, what the board has decided to do is to introduce a performance-related tender for all of the shares of this trust. So if in the 4 years to the end of November 2028, the net asset value total return is behind the MSCI China All-Share Index in sterling, then investors can choose to come out. They can sell all of their shares at close to NAV. And that's an interesting decision, I think. So this trust has had its ups and downs. It actually started quite well after it switched into the China mandate in September 2020. And then it subsequently became a pretty awful performer as China fell and growth stocks also fell out of fashion. So the 3 and 5 year track record looks pretty awful. The discount is around 15%, so that all looks quite poor. But of course, this might come back. And the whole point, I think, of investment trusts is that they offer the benefit of permanent capital, and that means you can take long-term views. But this kind of performance-related tender offer is existential because effectively, if the trust has a bad patch, it's going to go out of business because the investors are going to all dash for the exit. So it undermines that whole idea of permanent capital. And I think there's one other factor here that maybe I've thought through and it seems to me a big problem, which is that there's only two ways for the management to go here. They're either going to outperform or they're going to underperform. Now, if they're outperforming, they're incentivized then to take their foot off the gas, aren't they? Because they don't want to take too much risk. Because if they take a lot of risk, that's the end of their trust. So potentially they're not going to benefit fully from their conviction. And if they're underperforming, are they then going to load up the risk because they're desperately chasing the benchmark? So I think it's putting an enormous pressure on the managers and potentially in a way that's bad for shareholder returns. So I really don't like this trend towards uncapped tender offers. And they don't have to be uncapped. You can just limit it. You can say that actually you're going to cap it at 15% of your equity or 20%, which is still providing a partial exit. You're still putting some cap on the discount that can arise. So this is not a policy I like. I think I've made that quite clear.
So it's more a question of how you structure these control mechanisms, as you like, or give shareholder options about the future of the trust. Yeah, I take your point. I mean, 4 years is a sort of random number, isn't it? We don't know what the world's going to be like in 4 years' time. So it's a balance. It's a trade-off, I guess. But personally, I would agree with you. I prefer perhaps a capped opportunity more frequently, perhaps periodic intervals. And then there's always the option of shareholders actually winding the whole thing up if they want to. So it's not as if there aren't other ways to do this. Interesting point you make there. Do you have a view of the China Trust? Do you have one that is particularly a favourite of yours?
Well, none of the China trusts have covered themselves in glory of late, but of course they're subject to these enormous macro headwinds and tailwinds, aren't they, that come and go, and quick decisions by Chinese politicians that can change the landscape rapidly. So I think it's quite a difficult judgment to make, but the one I have favoured is Fidelity China Special Situations, which has, I think, done a bit better than the others, certainly over 5 years. But you're taking quite a risk if you're investing in a single country China fund. And I think many people I speak to feel that India has much better prospects if you're after a single country fund, or actually my preference is to go for a regional fund. I think if you're looking for Asia Pacific exposure, you can get that with a bit of China, but also a bit of Vietnam and other countries. So I tend to think you should diversify your risk a bit.
Yeah, well, certainly India and China, they dominate the emerging market indices, but they perform in very different ways. So you're right, that may be a case for diversified exposure there. So that brings us to the end of this edition. Andrew, thank you very much for joining us. I got a sort of flavour that you're feeling relatively... Are you feeling sanguine about the future? Are you feeling optimistic? Or are you feeling that maybe we're in for a bit of a reaction against this euphoric US reaction, in particular to the recent developments?
Well, I think we might see a little bit of mean reversion, a little bit of settling down. So potentially the US has got a bit overexcited, but the UK maybe has got a bit too depressed. So those things might balance up a little bit. But actually, I think there's a lot of optimism in the market at the present time that we might see the traditional end-of-year rally. So fingers crossed, I think.
On that note, that brings us to the end. So thank you, Andrew, for your, as always, wise counsel on these matters.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. Please note that podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.